Welcome. Welcome to this year's conference of the Institute of Finance and Financial Regulation on Asset Management for Institutional Investors. I am George Skiadopoulos, Director of IFFR. Now, I would like to welcome you all. We have an impressive number of registered delegates, more than 420 from all over the world. So thank you very much for joining, and thank you to our speakers and of course to our sponsors, which I'm going to mention briefly. This is the 6th consecutive year that we are running the asset management series, and as it is the case with the previous year, we are honored to have again this year a lineup of distinguished speakers who are going to address a number of timely topics in asset management, ranging from market outlook to alternative investments, regulation, trends, challenges, and advances. May I inform you briefly about the structure of the conference in case you may not have attended previous versions? So we're going to have structured presentations with slides, as well as roundtable panel discussion. May I encourage you to submit any questions you wish through the platform, the electronic platform. So these questions are going to be used for the Q&A sessions following each session. Also, I would like to encourage you to fill in the questionnaire, which is going to be distributed to you during the conference. These responses are very valuable to us in order to improve our services to you. So before moving on, may I thank our sponsors. We view our sponsors as long-term collaborators, and this year we are honored to have as gold sponsors the 3K Investment Partners, Alpha Asset Management, Iolcus Investments, and Piraeus Asset Management. We have as a silver sponsor Systemic RM, and as an affiliate sponsor Alpha Trust. I would also like to thank our supporters, in particular Kaya Association, CFA Society Greece, the Hellenic Bank Association, the Hellenic Fund and Asset Management Association, and the University of Piraeus Research Center. I should state that IFFR is running under the auspices of the Department of Banking and Financial Management of the University of Piraeus, the oldest department in finance in Greece. Nevertheless, its focus is international, and that's why our activities enjoy worldwide visibility. I would also lastly like to thank our media partners, in particular Business Daily, Euro Today, Mono News, and Next Deal. And last but not least, I would like to thank the IFFR team for its dedication and for its hard work, thanks to which this conference is feasible. In particular, I would like to thank Ms. Maria Giuli, and I would also like to thank Mr. Stavros Efthimiou. So without further delay, may I pass to the first session of this conference, which is going to be chaired by Mr. George Panagopoulos, who is the president of the CFA Society Greece. This session is going to be on advances in regulation. We're going to have a distinguished speaker, Jeff Mahoney. So George, the floor is yours. Thank you.
Yes, hello everyone from my side, and thank you, Mr. Skiadopoulos, for the kind introduction and the invitation. Before I introduce our distinguished speaker, I would like to say that at CFA Society Greece, we are very pleased to have supported this conference over the years and be part of today's discussions, given its significant influence it has within the investment community. So, for this first session, it's a real pleasure to welcome Mr. Jeff Mahoney, who has served as General Counsel for the Council of Institutional Investors for nearly 2 decades, and before that was Counsel to the Chairman of the Financial Accounting Standards Board, among other roles. Jeff will share his perspective on how regulation impacts asset owners, recent regulatory actions by the U.S. Securities and Exchange Commission, and key rulemaking initiatives relevant for asset owners. After his remarks, we will take questions which I will raise on your behalf, so please feel free to submit any question or inquiries you might have through the conference app. Jeff, thank you for being with us today. The floor is all yours.
Thank you, Professor. I have a few slides to share, so if you give me a moment. Okay. Thanks again, Professor. I really appreciate the invitation to speak to you today. It's a real honor and a pleasure for me to address the members of the Institute of Finance and Financial Regulation. Over 30 years ago, I spent a very memorable month vacationing in Athens, island hopping from Mykonos to Santorini and everywhere in between. So given IFFR's location and many connections to Greece, before I begin my prepared remarks, just want to make clear to you, Professor, anyone listening to me today, that I will accept any future invitation to speak in person at any IFFR event held in Greece. Now, on to address my assigned topic entitled, How Does Regulation Impact Asset Owners? The Case of the U.S. SEC. My agenda in the next 10 minutes or less is to begin with a brief history of the Securities and Exchange Commission, its mission, and some of its recent regulatory activities. Then in the time remaining, I'll be happy to take any questions from members. So as many of you know, the history of the SEC goes back to 1934. It was founded during the height of the Great Depression in the United States. The SEC, since its founding and to this very day, has a three-part mission: to protect investors, maintain fair, orderly, and efficient markets, and to facilitate capital formation. With respect to asset owners and asset managers, the SEC has a number of unique responsibilities. Those responsibilities include ensuring that investors have complete, accurate, and truthful information from issuers and those who publicly sell their securities. Second, the SEC also has a number of rules and regulations to provide information to investors with respect to their voting power. So information around the proxy statement to assist investors in making their proxy voting choices. And third, another important element of SEC regulation relates to submitting shareholder proposals. Since 1942, the SEC has had a rule called the Shareholder Proposal Rule, or Rule 14A-8, that allows qualifying shareholders to submit proposals for inclusion on a company's proxy statement for a vote at the company's annual meeting. So I'm going to spend most of my time talking about some recent activities of the U.S. administration, the White House, and its Securities and Exchange Commission that have led or may lead to a weakening of those shareholder rights, some of which I just mentioned, that are concerning to U.S. asset owners as well as a number of asset managers. So first, in December, the White House issued an executive order that some commentators have described as an all-out war on proxy advisors. Currently, two private companies, Institutional Shareholder Services and Glass Lewis. They dominate the U.S. market for proxy research services, and they are the direct focus of the December executive order. For many decades, many asset owners, other institutional investors have voluntarily contracted with ISS and/or Glass Lewis to provide research that assists those funds in applying, on a cost-effective basis, applying their own proxy guidelines to the thousands of ballot items they annually vote on at the companies they own. Among other things, the executive order directs the SEC and other federal agencies to increase their regulatory oversight of ISS and Glass Lewis. The order alleges that ISS and Glass Lewis exercise radical, politically motivated agendas, prioritizing environmental, social, and governance issues, and diversity, equity, and inclusion factors over investor returns. The order also emphasizes the foreign ownership structure of ISS and Glass Lewis, alleging that that structure raises national interest concerns. So, for the record, ISS is majority owned by Deutsche Börse, a German stock exchange, and Glass Lewis is majority owned by Peloton Capital Management, a Canadian private equity firm. So just think about that for a moment. The current U.S. administration is expending significant resources investigating whether a German stock exchange and a Canadian private equity firm are threatening U.S. national security through their ownership of proxy advisory firms. In addition, earlier in November, the Securities Exchange Commission announced a fundamental change in how it oversees its longstanding Rule 14A8 that I referenced earlier in my remarks, the shareholder proposal rule. That rule permits companies to qualifying companies to provide a proposal that companies include on their proxy statement for vote by the shareholders. Those proposals are almost always non-binding, so the company actually is not required to do anything. And they are viewed by many asset owners and asset managers as cost-effective ways to have a discussion among shareholders in the company about important issues that have, in many cases, contributed to improving corporate governance over the past decades. Historically, the SEC has exercised oversight, reviewing companies' requests and requiring a demonstration by the company that the proposals offered by shareholders violated specific exclusionary criteria in SEC Rule 14A8 before a company could be allowed to omit those proposals from its proxy statement. Now, however, in accordance with the November announcement, the SEC is no longer providing substantive guidance on most company requests to exclude shareholder proposals. As a result, companies are now generally able to exclude shareholder proposals based on their own unqualified representation that they possess a reasonable basis to do so under the SEC rule.
Jeff, I'm sorry to interrupt, but before you continue, I just want you to know that you are not sharing your screen. So I don't know what you have done so far. If you can fix that. Thank you very much.
Let's see if I can fix that. Marie, I'm not sure how I can fix that. You can't, you're unable to see my slides now?
Now we can, yes. Now perfect.
Oh.
You can continue. Thank you.
Okay. Let me move ahead. This is the slide I was on. So I was talking about the November staff announcement by the SEC. So that that staff announcement, as I mentioned, it fundamentally changes how the SEC oversees this longstanding Rule 14A8 that I referenced earlier in my remarks. 14A8 permits qualifying shareholders' ability to offer proposals for inclusion on a company's proxy statement, be voted on at the company's annual meeting. Those shareholder proposals are almost always, as I mentioned, non-binding. They're viewed by many asset owners, including by many CI members, as an essential, cost-effective tool for expressing the collective voice of a company's shareholder on a wide range of issues, and have made important contributions to corporate governance for decades. Historically, the SEC, as I mentioned, has exercised gatekeeping authority, reviewing companies' requests to exclude shareholder proposals, and requiring a demonstration by the company that the proposals offered by shareholders violated specific exclusion criteria in the SEC rule before a company could be authorized to omit the proposals from their proxy materials. But now, because of this new November announcement, the SEC is no longer providing substantive guidance on most of the company requests to exclude shareholder proposals. And as a result, companies are now generally able to exclude shareholder proposals based on their own unqualified representation that they possess a reasonable basis to do so under the SEC rule. Thus, the SEC is now merely confirming the lack of objection to the company-provided rationale. Now, this November announcement followed an October speech by SEC Chair Paul Atkins that surprised many investors and companies alike. In that speech, the chair of the Securities Exchange Commission suggested that existing Delaware corporate law that governs the activities of more than 50% of U.S. public companies, that existing Delaware corporate law does not require companies to include non-binding shareholder proposals in their proxy materials. And the SEC chair went further by indicating that the SEC would likely honor Delaware company exclusions of shareholder proposals if supported by the company's legal counsel in a legal opinion. So the combination of this SEC shareholder proposal deregulation, as well as the executive order I mentioned earlier that threatens the imposition of proxy advisory restrictions, these are just but two examples that appear to be part of a broader effort by the current administration and its Securities and Exchange Commission to weaken shareholder rights and potentially limit company board and management accountability. So my slide raises a couple questions of what this could potentially lead to. So, in my personal opinion, to the extent asset owners and other institutional investors are unable to successfully compensate for these actions and other actions that have been made by the administration and the SEC, it's possible that if these actions cannot be remedied or reversed in the near term or cannot be compensated for, then risk-adjusted returns may be negatively impacted for some companies. In addition, the probability of a repeat of the 2008 financial crisis originating in the U.S. and leading to large losses is something that the probability of that occurring again is likely elevated because of these actions. So on that lack of optimistic note, let me stop now and I'll be happy to take your questions.
Thank you very much, Jeff, for sharing your insights with me. One last question that I think it's very much related with European asset owners. I mean, for European asset owners that invest globally and especially in the US markets, which SEC regulatory developments should be most considered monitored in your view? And how do you see the rules interacting with the European regulatory frameworks? One quick answer, given that we're now running out of time, if possible. Thank you very much.
Yes, I would recommend monitoring the SEC's website, particularly with respect to their press releases and with the speeches of the SEC chair. There's been a lot of activity in the recent weeks, and I think there'll be more activity going forward that's relevant to asset owners and asset managers. So I would recommend that the SEC website be monitored, because I expect a lot more activities to be coming out of the SEC and the administration that impact investors in the coming weeks and months.
Thank you very much, Jeff, once again, for sharing such a clear and practical perspective on how regulation affects assets owners globally. And thank you as well for the audience for your questions and engagements. With that, I will hand it back to Mr. Skiadopoulos to continue with the program. Thank you very much.
Thank you.
Thank you, Jeff. Thanks a lot for showing to us the recent advances from the side of US SEC on asset managers.